Hello and welcome to Your Thriving Life. I'm Dr. Rowe.
And I'm Kathleen Noden.
And today we have Silvia Christensen joining us from Wealth Builders Realty. And we are so excited to have her on this show to talk about financial wellness. Silvia, how are you today?
Hey, ladies, I am doing well. Thank you so much for having me on. I'm excited.
Oh, yeah, we're excited to have you. People sometimes ask, how do you figure out who you're going to have on your podcast? And the name Your Thriving Life basically says, we want to try to find people in the wellness industry. Now, when you hear wellness industry, you might think, people who do massage or doctors or chiropractors, or, and which is all fine and dandy. We want to have those people too, and they're great. Also, we have people who talk to us. Kathleen is a relationship coach, and I deal with health and wellness. And we have people who come in and talk to both of us about issues that they're having with finances, and for relationships, that can be a huge issue. And for my patients who are having, anxiety or stress or insomnia, finances can sometimes be the root cause. So we feel that this is a very important topic, and we're really glad to have you on, Silvia.
Absolutely. And you are right on, Ro. I think a lot of it is, especially in relationships. I just heard on another podcast, this guy said, you should marry for money. And of course, when everybody hears that, you go, what? Oh my gosh, how dare you say that? And you have to take a step back and say, no, he said marry for money, not marry for wealth or whatever, right? But I think the important part of that is what he was referring to actually was you marry for money and actually the way you handle money. So when you pick a spouse, right, when you have a girlfriend, boyfriend that might, progress to marriage, you want to make sure that you are on the same page when it comes to how you handle money.
So your financial philosophy.
Exactly.
Okay.
And I just think a lot of the times, kind of know thyself, right? We all come from different backgrounds. Some of us may have come from parents that were penny pinchers. That would be me. My mom very, very rarely spent money, and she taught us the same way. We were very, very tight with our money. And that came, of course, from the way she grew up, very little money in the family. My husband, on the other hand, middle-class family, money was more of a, hey, no, I don't really want you buying that, so I'm not going to give you the money, right? So I think when people start looking for that, forever person, they really need to have that conversation. When they don't have that conversation, you get to marriage, you get to the hard realities of, hey, sometimes there's not always enough money. How do we spend our money? And you have a lot of conflict. So having those philosophies be on the same page, man, it goes a long way. Definitely goes a long way.
Kathleen, I bet you have had to give some of that advice in relationship coaching. Am I correct?
Oh my gosh. It is probably one of the top 3 topics that come up, especially if someone is, having some challenges in their relationship. Finances is always mentioned. So yeah, it's important. Once you're in a relationship, then you've already made that choice. So now how do you come together if you do have different financial philosophies? So I love that advice, Silvia.
Thank you. Yeah, no, it is. And like you say, coming together after the fact is, that's where the conflict is. But you can do it, right? Really, it comes down to what is best for the family or the relationship or the marriage, right? Wherever stage they are. But there's a lot of programs out there. You can look at Dave Ramsey for one. He definitely has a very, very strict philosophy. And actually, Dave Ramsey, if you listen to him, he'll always say there's always a spender and there's a saver in the relationship, right?
Right, yes.
Usually there's one or the other. Very rarely do you have both on the same page. So it's very common, very, very common to have one of each. I suppose, this is probably where you get involved, Kathleen, with your people that you coach, is how do you communicate what the most important thing for you is, your values, right? And try to put a plan in place for a long-term goal. And, that's really with finances. Gosh, obviously money cannot buy you happiness, but there's a lot of things that money can afford you. And, there's definitely some peace and some less stress if you manage your money in a sound way that will contribute to your mental health, to your physical health, right? And just that state of
Mm-hmm.
well-being that we're all after. Money definitely plays a role. It definitely plays a role in that.
So when you talk about money specifically, let's say a couple comes to you and they want to buy a house, and maybe they don't have much money, but maybe they have good credit, or maybe someone's trying to build credit. How does credit play a part in finances?
Yeah, so credit, in my opinion, is very important. Really, I believe that just the financial education that our kids are getting in school is sorely lacking. A lot of them
Mm.
don't understand credit. And I meet with young couples all the time in my real estate business who are super excited. They're planning a wedding. And after the wedding, they want to buy their first house and, just start this life, the next chapter of their life together. And, they come and they meet. Super exciting for them, super exciting for me. I would love to get them started. And of course, the shoe drops when they meet with their lender and they come to find out that, hey, all those credit cards that you opened up in college and didn't really manage properly are coming back to bite you. Or this debt that went to collections that you thought wasn't really important because you didn't understand how that worked is now rearing up its ugly head. And
Mm.
so I think teaching our children from a very young age, and this can be in stages, right? When my kids were little, we subscribed to the Dave Ramsey and philosophy. And so he basically said, you put everything in little envelopes. And that's what we did for our kids. Now, we didn't give them an allowance, but, birthdays, Christmases, grandparents didn't live nearby, and siblings, my siblings and my husband's siblings didn't live nearby. So they would send them money or gift cards, right? And so anytime that they did do something for money where they worked, we would always make them divide that money into 3 envelopes. So they had their spend envelope, they had their save, and they had their tithe, what we gave to our church or charities. And so them physically splitting up that money and putting it into their little envelopes, not only did they get to, actually handle the money and see how it was divided, but I think it ingrained those values and that mentality around money that, hey, you don't just take your money and you run right to the store, right? There's a process with how you handle money. When you receive it, what do you do with it? Oh,
Mm.
hey, you just got some money from grandma. Okay, let's go look at your little envelopes and how does that get divided? And we sit there and we calculate. And, I would expect parents to have, dollar bills and coins. You have like a little coin jar or whatever, so you can make change for them. But for our kids, what it did is it set in their mind from a very young age, there's always some money that we put in savings. Yes, we do get to spend some of it,
Yeah.
but we also give to our church and we give to others. And so those foundational, I guess, just like cornerstones of money and how you manage it really sets the foundation for them getting older. Because when they do start their own job, they have that mentality already. Hey, I got to save some of this money. Hey, I got to give to my church or give to my charity or whatever you want to do with that 10%, if that's the value that you put on it. I go to church, my kids go to church, so that's very important to us. But you can decide what those numbers look like. I think Dave Ramsey wants about 30% to go into savings and the rest you can spend. We always did 50% because, let's face it, what does a 5-year-old have to spend money on?
Yeah.
Right? They don't need anything. And I would say that can carry them even through high school. My kids are in high school right now. Actually, one's in high school, the other one just started college. They have part-time jobs. They still live at home. We don't charge them rent, but they have a few expenses that they take care of. But we still do that to this day where, hey, 10% goes to your tithe fund. Now, we're not using the envelopes anymore. That kind of went by the wayside. But now we understand with bank, accounts, how that gets divvied up in the same way. Now they're just electronic folders, so to speak. And, they understand and they don't fight me on it, right? Where I think a lot of conflict comes with parents when their kids kind of, get their job and they want to spend their money. It's my money. I get to spend it how I see fit. I don't want to save it. I don't want to give, or set aside or whatever. But if you kind of teach them from a very young age, it's automatic, right? It just becomes a foundation. And so, but building that credit, the next stage for my kids, high schoolers, we opened up a bank account. So a lot of credit unions, a lot of banks will allow you to open up their own little account and even get them a debit card. So both my kids have a debit card tied to their accounts. They have a savings account. They have a checking account, of course, and then they have another savings account where they move money over. And they also, my daughter, 19 years old, so, she's in college. We wanted to start building her credit up. So we actually got a credit card at our local credit union that I think it was a secured account because, of course, she has no credit up until this point. But I think it was, I don't know, $500 credit limit. So she took $500 of her own money that was in her savings account. They set that money aside, so they tie it so you can't spend it. And that's what's used to secure that credit card. Now, you might say, well, that's not really credit. Well, it kind of is because they're not taking that money out of her account. She's expected to, use her income to pay that credit card at the end of the month if she uses it to spend. But this, like I said, it kind of goes that next step to, hey, it's not money that's getting taken out of my account right away, right? Like credit cards are not. But I can't forget not to schedule that payment later. I get dinged, right? So she started that process of building credit. Now, there is such a thing as non-traditional credit. I know there's a lot of people that, there's still that mentality where I don't even want to deal with credit cards. Why do I need credit cards? I don't need them. It'll just get you in trouble.
Right.
Unfortunately it does, right? A lot of people that don't know do get themselves in trouble with a lot of credit cards. So there are means of getting these non-traditional credit established. You could do, let's say your kid has a cell phone. I mean, who doesn't, right? You probably pay that yourself if they live at home, but maybe you set aside a plan for them to pay that. Or maybe they pay their own car insurance.
So with that
Yes.
in mind, then you would, let's say, you have a family plan and your child is on the family plan for a cell phone, as an example. Does that mean you would ask the cell phone company to set up a separate account so that their name is on the bill to show, even if you're paying it, you could still it looks like they're building their credit that way?
Absolutely. So that is
Okay.
one of the ways. And there's different bills that you can use to do that, right? I mean, credit card, a cell phone is really just one of those things that could be very individual to your kid. But, maybe they have car insurance and you decide, hey, for your car, it's not that much of a difference. If you just pay it on your own, you pay that bill, right? The goal is to have something in their name. So when they look at that, they can come into the lender and say, hey, these are all the bills that I am paying on my own. Right. And they can verify that. There's a way to verify that so that they don't have to get a credit card. Now, I don't believe that credit cards are evil, to be honest. I use credit cards all the time, every day. It's a way for me to do my accounting in one place.
Yes.
Now, that being said, I pay my credit card bill off every single month.
That's the key, isn't it?
Yes, it
Yeah.
is. And so many people want to just do this little minimum payment. Gosh, at 24% interest rate, don't do it. It's so terrible.
That's why, and Kathleen, tell me if you experienced this. That's why in the 90s, I don't know if they still do this, but all those credit card agencies would be lined up in the cafeteria at colleges going, free money, sign up here. And you get a free backpack or a free satchel or a free, gift card to Taco Bell or whatever, and so all you hear is free. And so I was a victim of this because I didn't have someone to show me finances when I was young, and they didn't teach it in school. And I'm like, what? Free? That's great. So I signed up for Citibank And then went out and bought a bunch of clothes, and my bill came, and I saw the little minimum payment I had to make. Oh, here's my $30 for the $500 I just spent on clothes. Next thing I knew, I had racked up this immense bill due to the interest. And it took me years to pay that off. And, of course I know better now, but I had to learn the hard way. And I have a slight suspicion I'm not the only one who did that.
Oh my
Yes.
goodness. Same boat. And I didn't actually, I can't even blame like my parents for that, because my mom actually taught me quite a bit about money. She was in banking her whole career. And I just, as soon as I got that job when I was in my early 20s, I decided, she doesn't really know what she's talking about. I'm going to do what I want to do. And I ended up having to really just hunker down when I was in my 30s and say, okay, I need to do something about this credit card debt. And I did eliminate it, but it was a huge effort. So, yep, been there, done that.
It is hard. Yes, it is hard going backwards and going, oh man.
If I only had done that. Yeah. Now, I had a small business for a short amount of time where I worked for other businesses, setting up websites. And I also did filing. It was kind of a multi-purpose office support company, basically, that I owned. And there was one gentleman who I worked for. He went to MIT and he was a mathematician. And I had to do his filing for him. He said to me, I bet you're curious why I have all these credit card statements. And I was like, no, I just do my job. I don't, really wonder why people have certain things that I'm filing away for them, but he said, well, he was very proud of it. He said, let me explain this to you. He said, I get my statement and I pay it off every month. And then I get a new credit card that says you can transfer your balance. So then I transfer my balance and then I pay that off. But they give you a percentage off every month if you transfer a balance from an old card. So I just cycle them over and then I get all these perks and free hotel stays and travel. And it was amazing, all these little perks that he got.
Wow.
But he had to be on top of it. So if you are a mathematician major from MIT, you could probably do that.
Yes. Or
Otherwise,
very organized.
Yes. So there's certain skill sets a person has to have 20 credit cards at a time and not be in debt, I think. But he did it, and he did it well.
Wow. I think that I'd go crazy, to be honest.
Yeah, me too.
I'd go nuts.
I'm just not that smart. I wouldn't be able to do it.
Although I love the balance transfer thing.
Yeah.
That's actually how I got out of debt. Was I found, a credit card, actually multiple credit cards, that would give me a 0% balance transfer check, basically, so that I could transfer my balance from this credit card that I was paying probably 20 something percent.
Yeah.
And I did that, and I kept moving that money from 0% card to 0% card, so that all I was doing was paying down the principal.
Yes.
And that's how I did it. And I think that's a pretty common thing that people do these days if you have good credit. But again, it goes back to good credit, to being able to get those 0% cards, right?
Absolutely. Yes. Well, most of the time, and I'm not surprised to see this, usually, at least in my experience, what I've seen lately is they might give you that 0% interest for the term, right? Because it's not forever.
Right.
They do it for, 12 months, 6 months, whatever it is.
Yeah.
And you're right. Only certain people have access to those. But normally what I've seen, there's usually a transfer fee. So it's either a percentage or a minimum amount, $300 or whatever. So be careful with those. I mean, obviously, if you have thousands and thousands of debt that you're transferring and it is a flat fee, awesome. It would be definitely a great way to minimize that 25% interest that you would normally be accruing for, let's say it's a $300 fee. You can do the math depending on what your situation is and what your balance. But yes, they're definitely sometimes, you think the bank, right? They're in the business of making money.
Yep.
And so they try to get their pound of flesh somehow.
So Silvia, with that idea of different ways to take care of credit, to build wealth, to save and whatnot, if people are trying to save money so that they can buy a house, for example, What would you say is the minimum amount someone would need to save before they can even start looking for a house? Like, is there a percentage or is there a way to figure that out?
Well, so here's a caveat. Everybody's credit is different. Everybody's income is different. And everybody's debt is different, right? So those are the three pillars that most lending institutions will look at. They look at your debt to income ratio. They look at your credit score. They look at, like I said, not only the ratio of debt to income, but how much money you're making, which is going to directly translate to what your payment could be. But in general terms, let's say that you do want to buy a house. If you did an FHA loan, which is a Federal Housing Administration loan, it's usually got the lowest requirements for you to meet to be able to qualify. So the credit score is lower. For example, you can probably qualify for an FHA loan with a score of about 500 versus versus a conventional loan, which is going to require 620 plus. And so you will have a little bit more down payment if you do that 500. I think they require 10% down, right? 10% of the purchase price. Now, if you wanted to come in with 3.5%, which is why a lot of people do these FHA loans, you need to have a 580, which really 5 to 580 is really not a big increase to get that 3.5% down. So that's your down payment.
An entry point for a credit score, it would be 500 for an FHA loan, but for a 10% down of the purchase price. But if you wanted to only put 3% down, then you would have to start at 580 for your credit score?
Yes, 3.5%.
Got it. Okay.
Yes. Now that's for FHA. And so FHA, so that came out back in the 1930s. During that time, we were just, we were in the middle of that Great Depression.
Yeah.
There was not very many people that owned a house. And so the government was like, hey, we want more people to be homeowners. So no banks are lending right now. It's shaky. People have lost money, right? So to incentivize these banks to lend to people that may or may not have very good income or may or may not have very much savings, they rolled out these FHA loans. The difference is that an FHA loan is backed by the government, so they provide insurance for it. If you are a borrower and you can't pay your mortgage and you say, sorry, just can't do it, well, that bank is losing that money, right? They lent you that money for that house. Now, in order to minimize those losses, the government insures, meaning tells the bank, don't worry, make the loan. I will go ahead and pay that if they don't pay you, right? It's a federally guaranteed loan. Now, with that though, they try to give those loans to people that have possibly lower credit. Like I said, you can get in, 5 to 580, but also they will allow you to have looser credit ratios. And so credit ratios are a little tricky to understand, but basically these credit ratios refer to your debt and your income. So here's the thing, when you're going to borrow money for a mortgage, chances are that this mortgage isn't your only expense, right? You have property taxes, you have insurance, you have groceries, which are ridiculous right now. We have car expenses, we have clothing to buy for our kids that outgrow their clothes or whatever, right? There's other expenses that we need to live. Now, that doesn't even account to other debt. So these credit ratios, debt to income ratios for FHA, they will allow you to take your income and basically spend up to 43% of that income on all your debts, your mortgage and any, let's say you have student loans or credit cards that you still have to pay, but you still have good income, 43%, where a conventional loan is only going to allow you up to 36%.
Oh, wow.
Yeah. So there's so many great products out there. Now, here's the other thing. You mentioned how much money do I need to save to be able to buy a house? So there's really no right or wrong answer to this, unfortunately, because lending has gotten very creative. There is down payment assistance that you can qualify possibly. There's different requirements for that. And so let's say you don't have 3.5%. There's just no way you can save that money, but you make you make a good salary, and maybe your spouse does too. So your income is great, and maybe your credit score is great. You just don't have that money saved up. So there are down payment assistance programs that you might qualify for that will give you some of that money to put as a down payment. Now, like I mentioned earlier, you have closing costs, right? So that's going to be the title, the escrow, and any lender fees to actually give you this loan. Those can range anywhere from 2 to 3% of the purchase price. And you come into the closing table with that money with your down payment. So let's say you don't have closing costs, right? Because if we add the 3.5% down plus another 2 to 3%, you're almost at 6% over, right? Over 6% for that. That's quite a lot of money if your median home price is $500,000. Quite a bit of money to come in with. So closing costs, I've got a couple transactions going on where the sellers have graciously agreed to help the buyers out with some of these closing costs. Now, not all sellers are going to do it. Some of them might just say no. If there's competition for the house, you might not get that money. But we are in a market right now where you might. I have a couple transactions right now where the sellers are actually helping the buyers out with some of these closing costs. Not all of them do. In this case, that's what's going on, which is nice. The market is such that you could ask for those right now.
Oh, wow. So we don't have time in this podcast to dive into what some of these things are, as in like title, escrow, lender fees. Someone who's never bought a house probably has no idea what that means, what any of those things mean.
Sure.
So at some point, maybe if people want to ask these questions and try to figure out, like, this is great information, but I'm not really sure what all of that means. Silvia, is there a way that they could reach you?
Absolutely. So they can find me at mywealthbuildersrealty.com on the web. And I'm also on Facebook, Instagram, and actually just started a YouTube channel that covers a lot of this information. So those social medias are also at My Wealth Builders Realty. And yeah, I'd love to help. Obviously, if they want to reach out to me directly, probably the best way would be on the website. There's a contact us page there. I'd love to have a conversation with them.
Wonderful. I know I personally have a few more questions for you. I wanted to see how much time we have. Oh, we have a few more minutes. Maybe you would be able to answer a couple of questions. I'm going to fire these out, and then if that's okay. And then you can answer whatever you want to in that order, because I think you might already have these things in your mind at the top of your head. Maybe you're about to talk about them. I'm not sure. But I guess something I personally wanted to know is, or that I know that our listeners might want to know, is what are the positives of being a homeowner? I know if you rent, you don't have to pay for property taxes. You have the lawn mowed, you pay. If something breaks down, you don't have to pay for it because it's in your rent. So what are the positives of being a homeowner? That's one. And the last one I have is, I know that you can get discounts if you're a first-time home buyer, as opposed to someone who has bought before. There are certain loans for that. But if you're someone who's never bought a home, let's say you're a divorcee and you bought a home with your husband, but you never bought a home by yourself, can you be considered a first-time home buyer if you are on your own?
Okay, well, let's tackle that last one because I think it kind of goes hand in hand with what I was talking about for the Federal Housing Administration loan, that FHA loan. So the misnomer is most people think that FHA stands for first-time home buyer, which really it does not. FHA loans, a lot of people can use that loan more than once. So it does not stand for first-time home buyer. Like I said, FHA is Federal Housing Administration. So if you look at it technically, if you have never bought a house, then yes, you are buying a home for the first time, hence first-time home buyer. Now, the second part of that question, which is what most people refer to, is those discounts or special programs, right? So FHA, the Federal Housing Administration loan, is geared absolutely toward this first-time home buyer, strictly because, like I mentioned before, those credit ratios are looser, meaning you can qualify a lot easier. The credit score is lower than what you would need for another type of loan, and there is down payment assistance and closing cost assistance. The closing costs and the down payment assistance, those do apply to other conventional types of financing as well. But when you're a first-time home buyer, chances are you don't have very much money, right?
Yeah.
So when you're looking at this FHA loan, or rather just some of these other financing programs that would be able to help somebody in that situation, those are the types of programs that you're looking for. So if you don't have good credit, or you carry some debt, right? Maybe you have student loans, maybe you have credit card debt, maybe you have medical payments. Those types of programs, FHA, they lend themselves very well to people that might be starting off for the first time.
Okay. And how about why would you want to be a homeowner?
Well, so I think a lot of it goes back to being more in control, to be honest, and building that wealth. When you are looking at something, as a renter, let's say, yeah, there's definitely perks if you have a good landlord, right? But if you don't have a good landlord, that might be a different situation. But what
Yeah.
I'm seeing now, I will tell you, rents have gone up quite a bit. I mean,
Yes.
considerably in our area, right? It's just been really, really tough. And I will tell you, most of my buyers that are finally kind of coming up to that and saying, I need to buy. The reason is that they just can't afford that rent. And it makes more sense to pay maybe a couple $100s more and stretch that to be able to buy a house. Prices have gone up just ridiculous. So that equity is being built up. And, most people, when they buy a house, they're not buying it for 1 year, right? You're looking at a longer term. So those numbers obviously have to make sense for you. There are some very rare situations, in my opinion, where it might be better for you to rent, but the appreciation, the fact that you can do whatever you want with your house. If you want to paint it black, please don't. But if you do, you absolutely could, right? Plant a garden. You don't have to move within a year and not harvest it, perhaps, right? And you get to choose where you live and establish roots, right? So I would say the other reason, going back to what I was saying with why a lot of people are buying, I mean, interest rates, if you've heard, man, they're over 7% right now, right? Even though that's kind of more average, it's definitely a lot higher than what we had just a few years ago. And a lot of people are feeling that stretch there. Your payments going up significantly. But if you're living in a place and all of a sudden your landlord says, hey, I need the house back, you have to scramble to find somewhere else to live. So if you have kids and the dog and the cat, that could get pretty difficult to find housing in a market where housing is already tight, right? As
Right.
evidenced by our higher prices and our higher rents, right? A simple supply and demand. The more demand there is with less supply, prices are going to go up. We just don't have enough houses right now to afford everybody what they're looking for at the price that they want to pay.
So would you say that mortgage prices, even with the high interest rate right now, are very similar to the prices that a lot of people are paying in rent?
Well, it really depends on what you are renting.
Gosh.
So if you are renting somewhere for $1,000, which might be a one-bedroom apartment in Canyon County, you're probably not going to find a house that you're going to buy where your payment's going to be $1,000, right?
Okay.
So that might be what's going on there. But anyway, I think depending on what you're buying, payments might be very similar. If you're paying $2,500 to $3,000 in rent, a house might be something that you can afford.
Okay, that's good to know. I have a lot of people are telling me that they're having a hard time. paying rent right now. And my thought was, well, I wonder if it'd actually be cheaper to buy a house if you have good credit.
Yeah, me too. That's
Yeah.
such great advice. Thanks,
Yeah.
Sylvia.
Yeah.
Yes.
Yeah. I think if you have good credit, good income, and lower debts, gosh, yeah, I would say definitely look into that.
Well, my goodness, this has been a wealth, speaking of wealth of information, Sylvia. And, I don't know about you, Kathleen, but for me personally, I'm going to go back and listen to this podcast and take some notes.
Definitely, yes. So thanks again, Sylvia, for joining us here today. I'm Kathleen Noden.
And I'm Dr. Rowe. Be well, folks.